What happens if you ever find a leaky pipe? You're gonna slap a tape to temporarily fix the leak until you get a plumber to your house, right? But what if you have multiple leaks in your pipe? Then you're gonna need to replace the whole pipe. But before that, you're gonna need to turn off the water supply. And this country is facing multiple leaks in the 401k pipe right now, so to speak. And we can't seem to find a way to stop the leaks coming out of everywhere. The government is just now starting to realize how behind the American people are with their retirement savings. And they're trying to find ways to systematically plug every leak by making 401k transfers much easier and preventing further 401k early withdrawals. Secure Act 2.0, which was passed in late 2021, was one of the first actions Congress took to plug many of those leaks. There are two leaks we need to contain: the early 401k withdrawal and the lack of 401k transfers when you switch jobs. According to Bank of America, in 2023, there was an increase of 13% in the number of 401k early withdrawals. The average withdrawal amount was just over $5,000. Another study showed that 41% of 401k account holders withdrew at least some money from their 401ks when they switched jobs instead of rolling it over to an IRA or 401k. But the process of moving your old 401k to a new 401k is still too complicated and hard for the average Americans to understand. So let me get into the first part of this video, which is the process of a 401k transfer. For example, I recently moved my old 401k to my solo 401k, and that process alone took me almost a month to complete. Not many people know if they should call the old 401k broker or the new 401k broker to make the transfer happen. And not many people know how to properly fill out the 401k rollover form without the help of a financial professional. Why does anyone even need a financial professional to make a simple transfer happen from one 401k to another? That's precisely what policymakers are trying to do by making the rollover process simple for anyone to do. If you make a cash transfer from one bank to another with a click of a button, why can't we do the same with our 401k, 403b, 457, TSP, or traditional and Roth IRAs, right? Why did it have to take over a month for me to transfer my old 401k to my current 401k? So let me explain the rollover process for the next minute. You can always schedule your first session with me for free by visiting firesightchat.com/coaching. Let's say you have your 401k from company A from a long time ago. The first thing you need to find out is whether it has both Roth and traditional or just traditional. Keep in mind that Roth 401k is the money you already pay taxes on. Traditional 401k, on the other hand, is keeping your pre-tax dollars that you haven't been taxed by the IRS. So for this scenario, I'm going to say your old employer had both Roth and traditional, and you have money in a little bit of both. Option number one is to initiate a rollover from your old 401k to your current employer's 401k. If your current employer has both traditional and Roth 401ks, then you can do a simple balance transfer or rollover from your old 401k to your new 401k. The transfer is not a taxable event because you're simply transferring your money from one 401k to another. But what if your new 401k doesn't come with a Roth 401k? Then you can still do the traditional 401k to traditional 401k balance transfer or rollover, but the money inside your Roth 401k will have to stay with the old 401k. Or you have the option to make a direct balance transfer or rollover to your Roth IRA. Keep in mind that once you move money from your Roth 401k to your Roth IRA, this is an irreversible process. You can't ever move money back from your Roth IRA to your Roth 401k. So some people choose to move it to a Roth IRA, or some people choose to keep it in the old Roth 401k until they move to another job that comes with a Roth 401k. But what if your current employer doesn't come with a 401k at all? Then you can either keep your money where it is with the old 401k, or you can initiate a balance transfer from your traditional 401k to a traditional IRA. And the rollovers you make to your IRA or 401k do not count towards the contribution limits for the year. And think of it as a balance transfer from one retirement account to another. And you're just moving your retirement assets from the old basket to the new basket. That's it. But keep in mind that the IRS has certain restrictions on how many times you can make the rollover every calendar year. For example, if you have multiple IRAs and you want to combine them into one traditional IRA and one Roth IRA, you can only make one rollover once in any 12-month period. So if you have a Fidelity Roth IRA and you decide to move all of that money into a Schwab Roth IRA in February 2024, then you can't make another Roth IRA rollover until February 2025. And according to this CNBC article, many investors cashed out their 401k, 403b, TSP, 457, and IRAs, not just for financial hardship reasons, but simply because they didn't know about the 401k to 401k rollover process or the 401k to IRA rollover process without paying any taxes. Let me ask you this. Would you ever take out an ATM cash withdrawal with a 30% or 40% fee? You wouldn't, right? That's essentially what happens when you take out the pre-tax dollars you contributed to the 401k that you haven't paid taxes on. I know you feel like this is the hardworking dollars that you contributed, but you have to remember that the dollars you put in are not taxed yet. So when you take the money out early, you're going to have to pay the federal income tax, state income tax, and the 10% penalty. And if you take the Roth 401k dollars out early, you're going to be penalized and taxed on their earnings and interest. And before I explain how the conversion process works, I want to show you this direct rollover form from JP Morgan Chase. I'm just going to use it as an example, but generally speaking, all of the transfer forms are pretty much the same. And whether you have Schwab, Fidelity, Vanguard, or other brokers, you're going to go through this form anyway, or something similar to this. When you make a rollover request, you want to contact your new 401k plan or the current custodian who's in control of your 401k, 403b, 457, or IRA. You can't do this form until you have your new account open. And you also need to get the account number from your old 401k plan. And this is a problem because many people can't find their old 401k account numbers, or they don't even know who the broker was. You have to contact your old employer's HR to find that out. And if you're left on bad terms with that employer, that might make things a little awkward or make you hesitate to get in touch with them again, right? But anyway, let's go back to the article here. So the new 401k rule proposal is to have 6 of the largest 401k administrators like Alight Solutions, Empower, Fidelity, Principal, TIAA, and Vanguard to create a 401k portal, because millennials and Gen Z are more likely to switch jobs than Gen X or the baby boomers. Having a 401k portal could allow people to see all of their 401k accounts in one single portal. For example, when you move from one job to another, your previous job came with a 401k managed by Fidelity, and your new job comes with a 401k managed by Vanguard, then the portal can automatically allow workers to easily move their old 401k balance from Fidelity to Vanguard or vice versa. This way, workers' savings left behind wouldn't be cashed out or left behind and forgotten. The downside of the 401k portal is that the 401k broker has to participate in order to have the easy transfer capability. So if Schwab decides not to be a part of it, then people with Schwab 401k plans would be left out of the portal process. Those 6 companies I mentioned earlier covered only 63% of the 401k market, which is roughly around 60 million people. And Secure Act 2.0 gave a legal blessing to the auto portability concept, but the concept is not yet applied or set in motion at all. At the same time, Secure Act 2.0 created a massive 401k lost and found database so that workers can go back to find their lost dollars. And Congress is prioritizing this because every pre-tax dollar that's left behind in a 401k is the tax revenue they don't receive. Funny how they prioritize things, right? But that's just the way the business works in Washington, D.C. Here's another problem that American people themselves are facing, and that's the lack of cash flow on their budget. Ever since inflation went sky high in late 2021, there are a lot of things that are still expensive in 2023. Car insurance, for example, went up on an average of 20% year over year. And there are a lot of people who got laid off from the tech sector due to AI automation and cutting expenses. So many people turned to their 401k to make early withdrawals, and over 85% of workers who cashed out their 401k ended up draining their 401k. This is far worse than taking out a 401k loan. Is it always an inflation problem? Not necessarily. Some people have a serious spending problem, like I once did, that got me into that $110,000 in consumer debt, including a 401k loan. By the way, did you know that over 50% of Americans who make over $100,000 a year are living paycheck to paycheck? So is it always an income problem or a spending problem? If you're having trouble figuring out your budget, I encourage you to download a budget app called YNAB. YNAB stands for You Need a Budget. That's right. Whether you make $50,000 a year or $200,000 a year, every one of you needs to create a budget to achieve financial independence. You need to give every dollar a job so that you can be more intentional with your savings and spending. You can get a free trial without any credit card information by using the link in the description below. So let me explain the consequences of taking out a 401k early withdrawal. And let's say you have $10,000 that you took out early. So that means is that the IRS will automatically penalize you 10%. So that $1,000 will go directly to the IRS, but not until you file your taxes in the following year. You're going to receive what's called a 1099-R that shows you had a non-qualified distribution from your 401k. On top of that, you're going to get taxed by the IRS under the federal income tax. So Fed income. Okay. So if your taxable income is at the 22% marginal tax rate, then you could get taxed at 22 or 24%, if not higher. If you're at the 24% marginal tax rate with the $10,000 withdrawal, then that's another $2,400 that could be taken out by the IRS when you file your taxes. If you're single, then you could be taxed even higher depending on the total amount. If you're in a state that taxes your income, that could be another 5, 6, or 7% in income tax. And we'll just call that 5% or $500. Okay. So your final withdrawal could be from $10,000 down to a total of $4,000. And now your net withdrawal is going to be $6,000. So you could end up losing 40% of the original 401k value for making an early withdrawal. And I implore you, please do not do this unless this is your absolute last resort. If you wouldn't take out a loan for 30 or 40%, why would you take out a 401k for a 30 or 40% penalty and tax rates? And this is another problem that a lot of people don't realize, that what actually happens to their 401k if they decide to withdraw early. Not only do you pay 30 to 40% in taxes and penalties, but you lose a lot of earnings and interest over the years. For example, if you withdraw $5,000 from your 401k early, you could lose $45,000 in earnings and interest in 30 years. You could lose $30,000 in earnings if your time horizon is 25 years. A lot of people don't realize this when they take their 401k out early. You don't just lose your money, but you lose the time those dollars could have worked for you with compound interest. You can always use my compound interest calculator or download my 401k calculator for absolutely free by visiting firesuch.com/resources. And the other problem that American people are facing is the extra taxes they didn't plan for when they made a Roth conversion. One of the policy changes Congress is trying to make is to make the rules easier for people to understand how conversions work. That's pretty hard to do though, since taxes are already complicated enough for people to understand. And this is a Schwab Roth IRA conversion form when you move money from traditional to Roth IRA, right? The first 6 pages are pretty self-explanatory, and just with the phone numbers, account numbers, and other personal financial information. But if you look at starting at page 8 at the bottom, this is where people get really confused about what they should fill out. You can simply do the full amount if you want to convert the entire asset inside your traditional account. If you do that, you can just put the total cash that you want to convert in this block. But if you only want to convert a partial amount, then you'll need to enter the partial cash amount in the same block. So if you have $10,000 in traditional IRA, but you only want to convert $5,000, then you need to put partial conversion for $5,000. Now, you also need to fill out how many shares of a stock, mutual fund, or ETF you want to convert from traditional to Roth under in-kind conversions. For example, if you have 10 shares of the S&P 500 index fund in your traditional IRA and you want to convert all 10 shares, then you would put down all 10 shares here. If you want to do the partial conversion, then you put fewer than 10 shares, like say 5 shares. And for the tax withholding election, let me scroll down here. This is crucial to do if you're making a Roth conversion, especially if you have a large amount you want to convert. So let me show you how it works. Let's assume that you're single, making $75,000 in the year 2024. Your marginal tax rate will be at 22%. Keep in mind that this is after the standard deduction of $14,600. So your adjusted gross income is technically $60,400. This is also assuming that you have no additional deductions, adjustments, or tax credits. So if you decide to make a $10,000 traditional to Roth conversion, I'm going to add it to 85. Now, you're still going to be taxed at a 22% marginal tax rate right here, okay? Then you're going to be taxed at 22% of that $10,000 conversion. You would owe $2,200 in extra taxes of that conversion. So when you go back to the Roth conversion form, you'll need to put 22% right here in tax withholding for the federal income tax. And the question I often get is whether you should have the broker withhold taxes for you. The answer is it depends. The IRS in general requires you to withhold at least 90% of your taxable income. Otherwise, you will have to make a tax payment to make sure you're above the 90% threshold. If you don't have at least 90%, then you could be penalized by the IRS. If you have just one employer, then it makes sense to have the broker withhold the taxes for you. If you're a self-employed individual or have multiple income sources, then the taxes could become more complicated. So I would encourage you to talk to a local CPA to figure out your marginal tax rate before you get penalized by the IRS. And here are some potential solutions that the government could do to fix the 401k leakage. Since Congress a long time ago decided to do away with the pension plan for the private sector, they're going to need to regulate the 401ks more by making the 401k portal mandatory for every broker that manages a 401k plan for the American people. They already made a mess with the unregulated 401k system. There are billions of dollars in unpaid taxes from the lost and found 401ks. It should motivate Congress to find those pre-tax dollars. And solution number 2 is a radical one. And I'd like to hear your thoughts in the comment section on this. But what if we created a law to stop allowing early withdrawals? Any early 401k withdrawals, because the consequences are way too severe. But keep the 401k loan in place so that people can still borrow from their 401k for financial hardship reasons. A 401k loan has some negative consequences, but they're not as severe as their early 401k withdrawal. Don't get me wrong, I'm not recommending doing a 401k loan unless you're in a serious financial situation. I encourage you to check out this video that talks about the pros and cons of taking out a 401k loan, and I will link that video in the description below. And lastly, the government needs to prioritize financial education. High schools are still teaching old literature about Greek gods, but nothing about the consequences of taking out a student loan debt, a 401k loan, or carrying a credit card balance month over month. The school system needs to teach our kids how to adult before they become adults, how to create a budget, how to pay their bills, how to live on less than they make, and how to file a simple tax form. And this has been another beast of a video, and I hope you got a lot out of it.